Pratik Gupta now joins us. Pratik, good morning. Thank you for joining us. Pratik, the big question which I guess everyone is grappling with is that the 15-20% comeback what we've seen in individual stocks and benchmark indices, is that here to stay, or this will also get challenged and it's a matter of days and weeks that markets will retest the recent lows?
Nikunj, I think in the short term, it's very difficult to say, given this is the first time we have this kind of a medical health crisis. Frankly, one can never rule out that you have a second wave of reinfections and another wave of lockdowns, etc. That is clearly not being priced in. The market is pricing in a V-shaped recovery for the economy later on in the year. So there is a risk that if you do have another wave of reinfections, another waves of partial lockdowns, we could see another round of selling later on in the next few weeks or months. But I think what we are saying is it's more important to focus on the longer term picture, look beyond the next 6 to 9 months, look into FY22, FY23, and see how the earnings will pan out. Frankly, from our perspective, and on a personal note, I think it's more important to focus on what will be the likely lasting changes across industries, across companies, and focus on those changes. And there I would highlight there are, 2 or 3 key themes which stand out. First is, of course, while you will have a global slowdown and domestic slowdown as well, and so on, but you will see dramatic acceleration in consolidation across various industries. So the first point is focus on companies which can survive this downturn, and who knows, maybe you get a second leg down in terms of the economy, another lockdown, then the companies who can survive that to begin with. And second, then there are sector-specific themes, like, you'll have a lot more spending globally as well as in India on medical and healthcare infrastructure. You will probably see far greater acceleration in the trend towards digitization and automation. So those are the sort of broader themes to look at from the longer term. In the short term, yes, I think one can never rule out that risk, but that's not our base case assumption at this stage.
Right. Pratik, are you worried about the selling what is happening in private banks? These were like the poster boys which were gaining because PSU banks were losing market share. Some of the banks have made a great retail franchise, but do you think the core of the retail franchise now is shaking, and should one expect, if not underperformer, at best market performing returns from private banks? Is one better off reducing exposure to private banks? I'm asking a couple of bunched up questions here because private banks now are really leading the market decline.
No, see, the banks, whether they're private or public, they're basically leverage plays on the economy, right? The capital adequacy ratio for most of these banks is anywhere between 8 to 12%, in some cases, maybe even higher, 15, 17% or so. But, when the economy slows down like this, I mean, our estimate is this year we'll be lucky to get even 0% GDP growth. There's a risk we may see an economic decline as well in the GDP. So banks clearly are they'll bear the brunt of the impact on earnings and more importantly on credit costs, which if we see NPLs rising later this year, the credit cost impact will come into not just FY21, will probably linger on to FY22 as well. So the banks clearly, they get hit. So that's really, they were also the first to rally last couple of years. They've been leading the market. But bear in mind that these stocks have also come off almost on average anywhere between 35, 40%, in some cases even as much as 60, 70% from their peaks. Now, I think you'll have to differentiate. I think banks which have a greater exposure to the more vulnerable segments, such as microfinance, such as unsecured retail, such as SMEs, I think those will get impacted a lot more, those businesses, those banks. But then again, those stock prices have also taken a much bigger knock. I think banks which are much better capitalized, which are well managed, well governed, which have a conservative approach, which have lesser exposure to these kind of segments and have maybe perhaps in these times, we should probably focus more on the corporate focused banks. That's going to be hit less compared to, let's say, unsecured retail or SMEs. And even in the SMEs case, there is obviously an expectation that the government will come in with some kind of a package to help out the SMEs. But at this stage, we don't know whether that'll be enough. Maybe some of the SMEs are already in deep distress, maybe too late to get them to recover. But I think on banks in general, it's right now too early to say. A lot depends on your prognosis for the economy from here on. If you think that the worst is over as far as the virus is concerned, that we will not have a second wave or third wave, and we will start, getting back to normal in the next 3 to 6 months, then from a 1 year, 2 year perspective, some of the better quality banks, like I said, they are actually, looking quite attractive. But if you want to play safe and don't want to take too much of a risk, then obviously there are other sectors which are also quite attractive, the pharma sector, for example, to begin with.
What is the underlying thesis in buying pharma? Not all pharma companies are making hydrochloroquine. Not every pharma company will benefit with what is happening in US. Do you think in pharma it's more like a psychological tailwind rather than a natural earnings tailwind?
No, I think you're absolutely right. You have to differentiate. Right now, obviously, I think the pharma sector as a whole is getting a lift from this perceived perception that there'll be a lot more spending and on healthcare and medical facilities, etc. But I think you're absolutely right. You have to differentiate. You have to differentiate between what is likely to be a transient impact, which is a one-off, maybe jump in some companies because they're exporting HCQ, which again, frankly, who knows how long the demand for that will last. But I think you have to focus on the broader picture, companies which are perhaps better position in the area of, let's say, respiratory illnesses, chronic diseases, which have more of a India focus. Even before this virus crisis, we were actually bullish on the pharma sector, in particular on companies which had a larger exposure to the Indian market in particular. But now, as it turns out, even the US FDA seems to be, speeding up some of its approvals. And the pharma sector in general, historically, we've always been buying APIs from China. Now there's a concerted move to manufacture that in India as well. So as and when that happens, I think you will see companies emerge out of this. The companies that have been investing in their R&D capabilities, have been strengthening their domestic franchise, and have a good pipeline of drugs, especially in the area of respiratory illnesses, they should do quite well. But you're right, not everybody will do well. That's just a temporary uplift. That over time, I think you will see a separation on these factors.
When you see stocks like HUL rising the way they have risen in last 1 month, does it make you wonder that we are in a very narrow market? Because HUL logic is essentials are going to be consumed and the company will not take a hit. But that's like a bear market argument, isn't it?
No, you're right. It's a flight to safety, quality, kind of proxy for cash in a way. So that's what's happening over there. And obviously there are other factors like, they benefit from lower oil prices and so on. But I think that's at some point, if as and when you get clarity on an economic recovery, then frankly, some of these defensives may underperform. But for now, surely, I think that stock continues. Those kind of stocks will continue to outperform in the short term, till the time there is lack of clarity on both the global as well as the domestic economic environment, as well as other factors such as the fiscal stimulus from the government. Is it big enough? Is it not big enough? Does it imply there could be massive fiscal slippage? Could there be a rating downgrade? What happens to the currency? So there are a lot of other factors as well. At this stage, I think you're right. Risk appetite is not so strong, and which is why we are seeing a lot of investors focus on consumer staples, which is perceived as a relative safe haven in these times.
What is your sense on flows, Pratik, when you speak to your clients? Because frankly, March was all about outflows, and initial part of April also we saw on an average 2.5 to 3,000 crore of daily selling. Do you think that the bulk of the selling which came via the ETF route and other routes, is that behind us? Are we in for stable days of flows for next couple of months now?
Yeah, I think you need to keep in mind a couple of things over here. Firstly, in response to this virus, there's been a massive amount of monetary stimulus globally. The US Fed's balance sheet has expanded from $4 trillion to $6 trillion just in the last, I think, month or so. And that's also being emulated by some of the other central banks like the ECB, the Bank of England, Bank of Japan, even here in RBI. They've eased liquidity quite significantly. So there's a lot of money sloshing around globally, which is at 0% or sometimes negative interest rates. So, as long as we don't see the virus making a big comeback, unless you start seeing a spike in cases once again, even in countries like China and Hong Kong, which are beginning to come back to work, or in Italy or Spain, where the daily growth rate seems to be slowing down and the virus seems to be coming under control. So if you're gradually limping back to normalcy, all this global liquidity will have to will search for higher yields and higher earnings growth. And that's where India comes in, that despite a very sharp slowdown, which we are seeing, we will still probably be better than many other emerging markets, which either don't have such a strong macroeconomic position. For example, in our case, the fiscal, the forex reserves, the current account deficit, inflation, etc., is well under control, and the RBI has room to cut rates a lot more. Although we don't have the same amount of fiscal space, but at least on the monetary front, we can do a lot more. Unlike, let's say, some other countries like, say, Brazil and Mexico. Mexico, in fact, Fitch downgraded their rating yesterday. They're still investment grade, but they're heading, if things continue their way, they could be heading for junk. But my point is, India does stand out. And from our discussions with various clients, we haven't started seeing big inflows into the global active long-only funds as yet. Most of them are sort of status quo last couple of weeks. A lot of the buying has come in from the ETF funds. There has been a lot of rotation, which has been going on. A lot of our clients have taken the opportunity to churn their portfolios, buy quality, get rid of some of the junk in their portfolios, and so on. But we haven't seen a big, wave of redemptions either, nor have we seen a big wave of inflows as yet. So I think right now it's just sort of holding on, and let's see how it goes in terms of the virus. If like I said, if the economic situation doesn't deteriorate, or rather the virus situation doesn't deteriorate, then I think you'll start seeing some of these global funds getting more active. We've already started seeing that with the ETFs. A few long-onlys have begun sort of tiptoeing back into the market. And that momentum could accelerate if we have clarity and stability on the virus situation.
If you don't get clarity on the virus situation, which is the world continues to work with no clear therapeutic solution, partial lockdowns they continue, we may see a flattening in curve, and we will have to live a life which was not normal as what we lived, let's say, in January 2020. Then what happens to financial markets?
No, then you're right. If you're suggesting that we see another wave of partial lockdowns, reinfections, international travel remains very constrained, if at all it opens up, even domestic travel and so on, then the overall economic activity, not just across the world, but even in India, stays very, very weak. In that environment, like I said, financials are a leverage play on the economy. They will suffer. So in that sense, if that is the scenario you're painting, then yes, there is a lot more downside even from here. At this stage, I think no one knows. I mean, maybe, this is it. We've already seen China and Hong Kong and even Singapore beginning to recover and getting back to work. Italy, like I said, seems to be seeing the virus is peaking out. But at this stage, we don't know as yet. And which is why I think, like I said, it's you are seeing investors flock to the safer names in FMCG or even pharmaceuticals right now.
Okay. Would you be tempted to buy multiplexes, airlines, hotels? It may not be, you can't predict FY21 for someone, but for someone who say, look, I'm ready to take a FY21 pain, but I know FY22 is going to be a terrific year for them because the base effect would kick in, loss will become profit, demand will come back. By that time, vaccine would have got discovered. Would you say that it may not hurt to buy a top airline company, a top hotel company, or a top multiplex company?
I think firstly, you're right. For all businesses, for all stocks, we are recommending that we shouldn't be looking at FY21. We should be looking at FY22 earnings. Right now, it's just too early. In fact, I think it's a given that FY21 will be a washout for a lot of companies, massive earnings declines for many of these companies. But you're right. I think if you take the scenario that we'll gradually get back to normal, and by FY22, people will once again be flying around and going to the movies once again. I think the next 9 months, obviously, that may not happen, or it'll be very limited. Occupancy rates would be very low. Pricing power would be very limited, and so on. And in the case of multiplexes, you also have the issue of the pipeline of content that may remain constrained. But also bear in mind that these companies, I think human beings generally will not want to stay at home forever. So at some point, we have to assume that whether it's FY22 or maybe second half of FY22, things start getting back to normal and people start going out as well. So yes, it's definitely worth considering some of these investments. I think on the airlines front, I would be a bit cautious. You have to wait for some relief from the government first. The typical break-even for airlines is anywhere around 60, 65, 70%, depending on oil prices and so on. So let's also wait for what relief the government gives, whether it's on ATF fuel taxes or maybe something on the various airport landing charges, etc. And I think any airline which has significant international operations, we have to still wait and watch how that situation develops. But you're right. I think if you're taking a view on FY22, FY23, some of these stocks, it may be worth getting back into them. But bear in mind, these will be higher risk investments, so you've got to size your investment accordingly.
China has normalized. That's what data is indicating. That's what they're claiming. That's what the output seems to be indicating. And if you look at the industrial activity, do you see a large trade coming back into metals? Because if China normalizes, forget what they're exporting, but the internal demand for a country which has a population of 1.5, 1.6 billion itself is going to be so large that after a depressed period, if they are coming back, the demand to consume metals, materials is going to be large.
See, I think you're right that China is recovering, but the issue is the rest of the world, especially Europe in particular, which was even before this coronavirus issue, was already going through a very weak economic growth phase. They seem to have tipped into a fairly strong recession, and likewise in the US. The Eurozone may actually take a lot longer to recover, and also a lot of the emerging markets, I just mentioned a couple of them like Brazil, Mexico, even Indonesia, etc. They are slowing down. Some of them just don't have the ability to withstand an economic shock of this kind. And we may see depressed global economic growth despite China's resurgence. Now, you can argue that a lot of that is factored into the sharp decline in the metal stock prices. So you're right. I mean, it's too late to be bearish on metals, but I would say it's got to be you have to be a bit more selective. We would be slightly more positive on subsectors, or it's actually more stock specific. So the zinc plays, for example, relatively better, or if you want an aluminium play and so on. Those are relatively better. Steel, again, domestic steel is we prefer versus any global steel play. You have to sort of differentiate. I don't think you can make a generalization that all metal stocks are good or bad right now.
Okay. What will you not buy in this market? Everyone is saying don't buy companies which have a leveraged balance sheet. But if you look at any cyclical, any industrial, with the exception of IT, pharma and consumer, all companies have a leverage.
I think, again, I would go back to what I was saying earlier. You're in an environment where our Indian government's fiscal situation will likely remain stretched for some time, FY21 and FY22 for sure. So their ability to do capex is going to be constrained. In that environment, in such an economic growth environment, even private capex is going to be quite weak. So I would say, in general, the capital goods space is one sector which will take even longer to come out of this recovery. So that's one sector which you should sort of be more cautious on. The second is high-ticket, consumer spending. Whether it's four-wheelers or even some of the gold companies, perhaps it could take a lot longer for these guys to recover. So high-ticket discretionary consumption, the tourism plays and so on. Those areas I would be a bit more cautious until we get more clarity. But capital equipment for sure, and some of the, like I said, the high-ticket discretionary consumption plays.
Everyone is, Pratik, now saying that, look, we'll have to embrace more digital technology. We're using our phones much more. Our screen time has increased. Our dependence on a web chat or a web conference has increased, which means that the world will start embracing more digital tools, more technology. That's a serious reshift for a world which was already becoming digital, will now fast forward to become more digital quickly. So as an investor, how can one understand and maximize a opportunity or a stock or a company where we know that the world will be embracing more safety, more social distancing, and more digital?
See, unfortunately, in the listed space in India, there aren't that many direct plays on playing this theme, other than maybe you buy some of the telecom companies. That's rather the stronger incumbents. So that's one area which we've liked. As the other way to play it is through some of these IT companies, our Indian IT vendors. The issue over there is, again, you have to be very, very careful because while they will clearly benefit from this digitization theme, they will also suffer from sharp cuts in discretionary IT spending. Pricing pressure will kick in. Now, you can say that some of that will get offset by sharp cost cutting. Wage costs, wage increments will not be there. They will save money also through more automation, etc. But it remains to be seen how bad the pricing pressure will be. The one area I would also highlight as far as the IT companies are concerned is also the potential opportunity for getting more business from captives. India alone, we have, our analyst was telling us that we estimate about 800,000 odd people working at various captives across India. Some of these captives will clearly come under pressure, especially from some of the global financial services companies. They will have to take a tougher call on this, whether you do it in-house or do you outsource it to a offshore IT vendor. My guess is over the next 6 to 18 months, 24 months, you will see more outsourcing as some of these captives get shut down, and that will open up an area of opportunity for some of our IT companies. But in the very short term, you first have to worry about the pricing pressure. We are clearly expecting some, but the magnitude remains to be seen, whether it's just a 3, 4, 5% net impact, or is it going to be much more like 8, 10% pricing impact or even greater? And to what extent does that get offset by the currency depreciation as well? So a lot depends on how that plays out. But as far as the digital theme or, as you said, working from home, etc., unfortunately, there aren't that many listed plays I can think of offhand. The telecom companies are the only ones where I can see they will be clear beneficiaries. In fact, most of us who are working from home, all of us seem to have upgraded our bandwidth speeds and packages. And I'm sure as and when the lockdown gets lifted, a lot of us will go out to buy backup phones and laptops and so on. So I think there will be some spending, but it may not translate into higher earnings for some of the listed companies over here.
What is your view on auto? Again, these companies don't have a balance sheet risk. but nobody can figure out whether social distancing will benefit or not. I was talking to the chairman of Maruti, Mr. Bhargav, yesterday, and he said, look, coronavirus has helped Chinese car demand because nobody wants to use Uber and Ola, and people want to use their own self-driven cars, and that I think is logical. But where do you think auto fits in? Because auto is at that cusp where discretionary demand could come down because of crack in economy, or compulsions could force you to buy your own vehicles.
No, you're right. I think, there will hopefully, or most probably, I would agree with Mr. Bhar, clearly, that there will probably be greater demand for those who can afford it to buy cars and so on. Our preference is actually more for the two-wheelers, especially the mass market two-wheeler kind of companies, because our view is, firstly, the overall economic pie or the overall income levels have taken a big knock. So the affordability issue will kick in. That's going to be quite important. So we suspect that the first demand will come more for motorcycles and scooters. Cars also, especially I think entry-level cars, people will want to, as you said, they'll be worried about social distancing. But that's also, I think, more of a very short-term phenomenon. I think the bigger issue is over the next 12 to 18 months, the economic growth environment is going to be quite weak. Discretionary spending will be a bit weaker. So we would prefer two-wheelers to four-wheelers. The two-wheeler companies also have very strong balance sheets. Dividend yields are attractive. Valuations have come down quite a lot. Some of these stocks are now trading at barely 10, 11 times FY22 earnings. So from that perspective, the two-wheelers look less risky to us. With four-wheelers, while the argument about social distancing may work, you also have to worry about the impact on discretionary spending. Could that be much more than expected? And do people push back their car buying purchases simply because they can't afford it?
All right, Pratik Gupta, appreciate your time. Glad you could join us, and thank you for your valuable and insightful thoughts.